cycles. And I mean, you've been involved for a long time too. I remember you told me you got involved like in 2014,
2013, yeah.
2013. Yeah.
I wrote the first ever macro strategy piece on Bitcoin in 2013.
Wow. Whatever that was the report John Norman saw, and that, right?
Might have been, because all the hedge funds, everybody passed it around because it became this thing of like, so I onboarded everybody from Dan Tapiero to Mark Yusko to, I mean, you name it, all the macro people was all because of me. John Burbank, I mean, you name it.
I might say that that might have been your report because I don't know why John Norman would have brought up Bitcoin.
This would make Bitcoin a top-performing asset in comparison to traditional investments such as gold, according to Tom Lee, co-founder of Fundstrat Global Advisors, who forecasts that Bitcoin could reach $250,000 by the year 2025. His forecast is founded on a number of important considerations. To begin, he observes a change in the U.S. administration's attitude toward digital assets. He cites the presence of individuals in key positions at the Securities and Exchange Commission, the Federal Trade Commission, and the Department of Commerce who are perceived to be supportive of cryptocurrency innovation. It is anticipated that this modification will result in a regulatory environment that is more favorable for cryptocurrencies, which will in turn boost adoption and investment. Second, the legitimization and stability of Bitcoin as an asset class have been improved as a result of the growing involvement of institutional investors in the cryptocurrency market. In conclusion, Lee is of the opinion that the United States' use of Bitcoin as a strategic reserve asset will be the driving force behind its widespread adoption. He believes that other nations will likely follow suit, which will increase the value of Bitcoin as a hedge against economic uncertainty. During a recent conversation with Raoul Pal, CEO of Real Vision, Lee expressed his optimism regarding a market recovery, which will be driven by the policies of the new administration, as well as advancements in artificial intelligence and cryptocurrency. He explained the reasons why he continues to have a bullish outlook on Bitcoin and believes that there will be enormous investment opportunities in the future.
And then in 2017, I remember just for some reason, I think I saw the price of Bitcoin again, and I was like, whoa, this thing just went 10x in just a few years. And so I've covered stocks enough to know that sometimes when something does a 10x, it means there is something to it, not that it's a bubble. Like most people, I think, tend to think if something's gone up a lot, it's a bubble. But actually, in the equity world, a lot of times it's actually telling you something's real.
Particularly when it's a network. That's the big difference.
Yes.
Networks tend to do this much more consistently.
Correct. So with our not great understanding, we did spend about 4 months doing a research white paper on Bitcoin. It's exactly what you said. First, we found that if you just did a very simple two-factor model, which is the number of wallets and then activity per wallet, it explained over 90% of the rise of Bitcoin since inception.
Yeah, and it's a good approximation for Metcalfe's law. It's the best way I got of fitting Metcalfe's law to the network value.
That's right. And then, we realized that's exactly why social media networks created value. Because, I mean, the idea of like eyeballs and someone being the customer and then because it's free and you sell them out, like that was a very new concept. So to me, I had already believed in this idea that you could create businesses digitally that didn't start with a factory. And so we published our first report on Bitcoin. It was around $1,000 though. But we said that by using the same two-factor model by 2022, it could be $25,000. And that was either saying it was going to be worth 10% of gold or the number of wallets were going to increase. I don't remember the whatever assumptions we used. And then when we published at the time, I did it more as like a thought piece. And of course, I was advocating for Bitcoin. We recommended 2%, but it wasn't something that we thought we would hang our reputation on. But it created immediate backlash for us with our institutional client. who became very angry that we were trying to pitch something that had no tangible value and was clearly just used for buying drugs. So we actually got famously fired by several well-known hedge funds. And but then I assumed we were probably onto something because I figured if some
Yeah, that's right. When you see that reaction, it's probably right.
yeah, because if someone hates it, they haven't done the work.
Yeah.
And so now it's almost 9 years later, 8 years later. And Bitcoin's obviously done really well. It's actually had cycles, and I mean, you've been involved for a long time too. I remember you told me you got involved like in 2014.
2013,
2013,
yeah.
yeah.
I wrote the first ever macro strategy piece on Bitcoin in 2013.
Wow. Whatever that was the report John Norman saw. And that,
Might have been,
right?
might have been. 'Cause all the hedge funds, everybody passed it around because it became this thing of like, so I onboarded everybody from Dan Tapiero to Mark Yusko to, I mean, you name it, all the macro people was all because of me. John Burbank, I mean, you name it.
I might say that might have been your report because I don't know why John Norman would have brought up Bitcoin unless it was spinning around his desk,
Maybe it was. So I know we've got a hard stop coming up. So I just want to cover where we are today. So what's your framework for understanding the year ahead, next year? Just give me your data dump of, what are you looking at? What's interesting for you? How the macro plays out or the markets play.
I mean, I think the story arcs are pretty bullish right now. I mean, from the shorter lens, this incoming administration, I think, is doing things that look very disruptive at the moment, but I think structurally are really positive because it's a path for U.S. deficit to normalize. And I think, indeed, I think animal spirits are coming back, even though things like these consumer confidence reports don't show it. And we know that there is tangible drivers of productivity, including AI, in front of us that justify investors allocating capital. And of course, there's still plenty of disruption ahead, including crypto. And I think Bitcoin is still our favorite idea for this year. So we think it'll be the best performing asset class, even better than gold. But I think anchoring all of this is is a demographic story. I can send you some charts later, but if we look at the number of people aged 30 to 50 in the U.S., that's actually been steadily rising since 2009. It actually went positive in 2016. And what I mean by that is the number of people aged 30 to 50 matters in an economy because they're the ones that are driving both credit consumption, but also productivity, innovation,
and investment. In the end, I think all of macro is just demographics. By the time, if you do enough work, go deep enough down the rabbit hole, the one monster factor of all is basically demographics.
On a consistent basis, Raoul Pal has brought attention to the transformative power that artificial intelligence, AI, possesses on the economy of the entire world. He does not consider artificial intelligence to be a passing fad, but rather a significant force that is driving real demand across a variety of industries. NVIDIA, which Pal believes could see a tenfold increase in value over the next decade, potentially reaching $1 trillion in revenue, is one of the companies that Pal is particularly optimistic about. Pal is particularly optimistic about companies that are leading the revolution in artificial intelligence. It is clear that he is optimistic about the enormous growth potential that exists within the artificial intelligence sector. Pal views artificial intelligence as a catalyst for significant economic productivity, driving innovation and efficiency that will fuel robust economic growth. This is in addition to the fact that AI is used by individual companies. His perspective as a whole is consistent with a bullish view of the markets, in which artificial intelligence is regarded as a significant structural force that will shape the future of the global economy. In the years to come, artificial intelligence is expected to revolutionize various industries, increase productivity, and create significant investment opportunities, according to Pal's optimistic outlook
And then there's a contrast because, as you know, in the rest of the world actually has a depletion of population. And so that's creating the demand for AI workers, which is what the US tech companies are producing. So I think that this does feel like it's going to be a very bullish equity cycle ahead. And that's why we're constructive. And it's been a rough start for this year, but I think we're just sort of getting through some of the kinks and burning off some of the recent bullishness.
Yeah, I'm the same. We get the optimism about Trump, then we get the correction until we get the actual news story. How are you thinking through? I mean, you and I are obviously thinking through the AI in the same way. We're about to produce infinite workers. AI and robots is infinite human intelligence and infinite humans, right? I mean, this completely breaks the economic model. We have no understanding what this is going to do. But let's assume we'll get there whenever that happens. You're starting to even hear Satya Nadella start thinking, and this might be, I want to go back to the psychology of 2000, that many of these people worry about is they're worrying about, have we overbuilt? Or are we overbuilding data? Are we overbuilding chips? Are we overbuilding? I'm not sure that we're not still underbuilding, but we might be scarred. And I haven't decided, but where do you think we lie on this? Is this an overbuild and everyone's got to write off a whole bunch of capital, or is this still too early to say?
People who are going to call the top in data center demand have never really experienced industrial cycles, right? Because the cycles actually are going to extend until return on invested capital is well past negative. And I would be very surprised if we're already reaching that saturation now, because we know that any model today would have improved capabilities if you improved computing power or capacity. So we aren't even experiencing the negative side of that utility yet. So I think that it actually would still argue that you need to be investing more capital. And I know, like when you look at percentage of GDP, I mean, look at what happened with China when direct private investment, it got to 40% of GDP. And that lasted years before you had overcapacity in China. So I don't know how we're even at saturation today in AI, but that's just in broad strokes. So I agree with you. I think there's still a big runway ahead.
And here's something I saw somebody make a comment about this, and I thought it was interesting. A good one to talk to you about is we're now starting to see the Mag 7 actually doing capital investment, right? Which they've never done.
Yeah.
They just bought their own shares back. Is that a net negative or positive in their performance? Economic performance is probably good because capital investment was something we'd been missing for 2 decades. But no share buybacks or less share buybacks? Or does it still generate even more free cash flow that they end up just doing both?
Yeah. Well, I think it's highlighting two trends. One is they didn't do a CapEx, but they did R&D, which until recently was a P&L expense, not a capitalized expense. And so they're supplanting those dollars for capital dollars that become balance sheet assets. In a world of labor shortage, that means you have less OpEx because that's wages, but you'll have more balance sheet intensity because now you have a computer that you're operating. So I think in a world of labor shortage, balance sheet intensity will go up. So it makes sense that these companies are big spenders of CapEx now. But that does create another wave of innovation because cooling and power supply and uninterrupted power and all these become strategic advantages, which will create another wave of technology innovation. So I think that there's a lot of opportunity and waves of opportunity being created because of that change that you've just highlighted.
Yeah, I think you're right, because it's going to be a game of efficiencies because the cost of these models is going down fast, and the compute is going down, but therefore they can increase output. So it's just this tremendous race to get more efficient at every single component part of that flywheel, from energy to chips to compute.
Yes. And we've even seen it in the financial industry. The financial industry used to trade labor intensive, so had a lot of traders and people. and then they replaced all the traders with computers. But someone naively might have said, well, then financial companies' capex will go down because they already have computers trading for them. No, capex intensity and tech intensity of the banks has actually only gone up since then. So that arms race, without even AI, is consuming more dollars. And that's, of course, I think going to be the case with AI itself.
Lee suggests that, similar to the emergence of tower industries and Apple, the greatest AI winners may not yet have fully emerged, drawing a comparison between the current AI boom and the early days of wireless and fiber networks. He asks who the Apple of AI will be and what the tower industry equivalent will be, a silent source of long-term wealth. Lee also stresses that AI needs energy to operate, just like humans do. Finding the factors driving AI's development, whether it be new industries or energy infrastructure, may reveal the next big investment opportunities. Lee is still optimistic about Bitcoin and believes it will surpass gold by 2025. Despite recent declines in the cryptocurrency market, Raoul Pal shares this optimism. Pal explained in a series of tweets that global liquidity changes, such as a stronger dollar and higher interest rates that are now easing, are primarily to blame for the downturn. He predicts a sustained upward trend as financial conditions improve, comparing the current correction to the one in 2017, brought on by comparable economic factors. Pal stresses that the cryptocurrency market is still in its early stages of development and suggests patience. Both Lee and Pal urge investors to remain composed and consider the wider picture, citing AI and Bitcoin as major investment themes for the ensuing 10 years.